So it's getting recorded now, and we are getting into chapter 12. So after the midterm exam, so if we can recall, we went over it's kind of like the review for like tagging along with the CVP analysis, we did the special decision making, majorly looking for short-term decisions. So we talk about the relevant cost. So when you face a decision-making scenarios, it doesn't matter either auto-sourcing decision or like discontinue a product or a segment, or auto-sourcing decisions, make or buy decisions, that's like another name, or the special pricing decisions, and even the like the bottleneck decisions, so limited resources. So you may face different scenarios or conditions for your operations. It doesn't matter what type of industry you are. But the key issue we talk about in chapter 14, the special decision making, is identify the relevant cost and irrelevant cost. And we don't have a conclusive like definition telling you what are the relevant costs or what are irrelevant for all of the situations. But we teach and we learn is in different situations, how we can sort out the overwhelming data and just pick the relevant information, so relevant revenues or relevant cost and expenses. So sometimes the job is kind of challenging to sort all of the information. It's like when you do data analytics, when you initially got the data is not cleaned yet, right? So you got all sorts of like student data, student information, and all the courses information. But we want to clean up the data and sort out and only filter the useful information for the decision making. So that's kind of a tough job faced by the managerial accountants, because these days really like we are using the like data research, data analytic research to analyze the questions, collect the information, analyze it, and make the final decisions. So what I recommend is based upon the project we just finished. So we have some open like brainstorming. So like the second question, I'm asking some real cases from your working places. So what kind of managerial accounting scenarios? So you may have applied the concepts we have learned from the CVP or special decision making, right? So I got lots of interesting examples, even they're not really numbers presented, but I see lots of these implementations. I think the most popular is the like break-even analysis, target profit analysis, product mix, right? So when we have multiple products and multiple services, but we don't have all of the resources to implement, or operate all of them. So we need to rank the profitability of the products or services so we can have priorities. And someone even mentioned making the capital investment. So capital investment decisions, we can use the net present value. That's something probably you talk about from the finance seminar, right? So like so we have some overlapping regarding the capital investments from accounting and finance. But that's kind of like just a brief review for the prior learning module. Normally I put CVP analysis, special decision making, and even budgeting, also budgeting together, because budget is long-term planning for everything, master planning, master budgeting for the future operations, not only for the operations, is also planning for human resources and from your resource allocations, right? So it's a comprehensive forecasting and planning for the future operations. So that's kind of like the prior learning module. And now we move to chapter 12. So you can see the title, responsibility accounting and the balanced scorecard. Responsibility accounting, we developed this management accounting idea is with the decentralization. The development of the organization has been becoming larger and larger. So like the global conglomerates. In the initial days, like the company started, right? So we normally have one location and the limited types of services or products, right? So like on a smaller scale. But with the technology and also the funding become abundant, like the technology, now you can like internet, right? So cloud services. So now the companies are competing with each other on a scale as well. So like normally only we have the economy of the scale, right? The larger, people normally assuming the larger of the company, the easier to survive in the industries. So the size, you can see for each like industry, we have a few of the top, right? So the top companies with like the super-sized operations. So they are really the top players in each industry. So with the decentralized operations, so imagine if you work, for example, Walmart, like, that's, and also maybe ExxonMobil, right? So we have lots of energy companies headquartered in Houston, but they have operations in Asia, and they have the oil field maybe in Africa, right? So in South America. So if you have this decentralized operations as a CEO or CFO or the central management, how you make sure you have enough control of all of the divisions, like sub-companies, but in the meantime, you also give the managers in different levels enough flexibility and freedom, right, to make their own decisions when the time desires. So it's really hard, kind of like another challenge, right? So controllable, but also give flexibility and freedom. So that's like gradually they developed this responsibility accounting system to help the management operate the decentralized businesses. So this is really a direct help. Okay, so this responsibility accounting is not an external required or by the accounting regulation or government, is an internal management accounting system. So is assist, so the main purpose is assist the central management to control, but also give flexibility and freedom for different level of managers. So the company will be, they can make on the spot decisions and also make timely decisions, like, react quickly to the market demands or some operational conditions. So that's kind of the purpose, the history for the responsibility accounting. I think we have a relative 70, 80 years history. Okay, so not a long time, like, history for the responsibility accounting. And then based upon, you can see the segments, right? So we have different responsibility centers, but how we are going to evaluate their performance. So performance evaluations for the internal segments or internal divisions. And we used to have some simple, right? So you probably know KPIs, right? So like KPI, especially for profit companies. For each division or departments, we have different KPIs. And the KPI, you can have financial KPIs, numerical KPIs, or non-financial KPIs. So Balanced Scorecard is a comprehensive evaluation system, incorporate all of the KPIs and other evaluation mechanics. So the companies can use this concept and adjust it. Sorry, it's my dog. So they can have a comprehensive and comprehensive evaluation system, or they can apply to their internal operations. So it can be for individual employees or can be for the whole department. So that's kind of the two major topic covered by chapter 12. Okay, so majorly focus on decentralized organizations and performance evaluation. And we introduced these two tools to handle the operation in those requirements. So yeah, before you dive into the details, also how this chapter fits into the overall structure and what are the main purpose. And they use the sample like two companies like to introduce, like because we want to have some concrete feeling about the responsibility centers and their performance evaluations. So they introduced a hotel chain, and another one is a fund tech service or a service company to introduce the balanced scorecard. So that's kind of the two streamlined examples we use consistently in this chapter. So you can take a look for the learning objectives. I did upload the PPT, the slides of this chapter into the Blackboard, but I like to use the smart book because sometimes like I think the PPT is kind of too simple, or they really didn't cover enough. Okay, so I want to give you a feeling because we require the smarter book as a graded assignment. So I just want to walk you over, about how I'm going to so what kind of the priority and what's something I really want to pay some special attention, okay, to the context. So we have the learning objective. Okay, so there are 8 of them, but you can see majorly, we are talking about the 2 major topics: responsibility accounting, and then the balanced scorecard for performance evaluations. So the responsibility accounting, the purpose is trying to fostering goal congruence between the different departments or divisions for the company, right? So for different departments and divisions, rather than you work for the best benefits of your own division, we should look for to achieve the best goal for the overall company, right? So we try to use the responsibility accounting design to encourage or incentivize the employees, their goal, the goal of their operation should be for the overall business rather than to maximize the benefits for their own individual departments. So that's kind of the intro session, so like the purpose. And now let's get into, so today I think I will just focus on the first topic, the responsibility accounting. And then Thursday, we can go over the segment reporting and the balance scorecard. Responsibility accounting, as I introduced in the beginning. Okay, so now most of the organizations in the current days, so they are divided into smaller units. So when I read the book, I like to highlight some of the key concepts or sentences, right? So that's kind of give me the brief idea. Okay. So decentralized organizations, you divided your company or business into smaller units. But like TSU, even that's for non-business organizations, we have a decentralized operations, like in the city, in the state governments, right? So they have like public services, they have airport services. So for each department of units, you have different goal of your operations, right? So each department, Jenny. Sorry, the dog is really not annoying. Uh, so the organizations are divided into the smaller units, and depending on their nature, they have different responsibilities. So in that case, how we can make sure they are working towards the overall goal of the business rather than for their own benefits. So from the behavior side, we have the goal congruence issues, right? So like consistent or converge the goal from your divisions. But if you don't have a system to monitor their operations, so each of the departments or subunits, they can, like for example, when they're looking for like maybe product choices or like special pricing of orders, so they may just try to maximize, like, so they want to maximize their own KPIs, but in the meantime they may sacrifice the profits of the overall company all at the cost of other departments. So later in when you see the behavioral discussion later in the chapter, they talk about, I remember you have the sales department and the production department. When the sales department accept too many like rush orders, right? So like a rush order from a customer, the sales department always want to grab the rush orders because the revenue can boost their own performance as sales revenue. But these rush orders will disrupt the already scheduled operation of the manufacturer facilities. So production manager, when they receive the rush orders, they need to make time and make labors available to make the rush order in addition to their regular operations. So they may mess up, right, their operational schedules. So in that case, you can see there is a problem about the goal congruence. The sales manager is trying to maximize their own performance, but at the cost of extra cost and a hard job on the production manager, right? So if you don't have a nice system to make them work together, so the grip like the grip between the conflict between the two functions may become larger and larger. Then how you can solve this problem? So like the managerial accounting can step in, so give some of this extra production cost related to the rush order. Like if I accept a rush order, I need to order material, organize my labors. So the sales manager will share some of the extra production cost due to the rush orders. So rather than the production manager take all of the tolls from this actual work. So in that case, the sales manager will be especially careful when they think about the rush orders, rather than like accept all of them, and then kind of relieve some of the burden from the production side. Okay, that's just an example to show this goal congruence. But before that's like saying this very critical. Also, responsibility accounting has been used widely in different type of organizations to ensure we have less friction between the departments. So everyone and every function is working for the best performance of the overall business. Okay, so that's kind of a example. And how they design the responsibility of accounting is not really each department or division, you have your own accounting system. Or be careful, it's not really we are decentralize our accounting system, is we give different responsibilities and resources to each division or departments based upon their operational feature. And we call this responsibility centers. All right, so it is like so responsibility center will define the role of each department or division in the structure of the overall company. And most popularly, we define four types of responsibility centers, depending on like the resources they have and the responsibilities. So in the bottom, we have a cost center. And then above that, revenue center, profit center, and investment center. So cost center by the name, so we can tell for this cost center is a subunit, department or division, and whose responsibility is only for the cost incurred for that subunit. They are not handling, so they are not facing customers. They are not related to making revenues, but they are responsible for the cost incurred to provide, to to generate the expected result from their operations. Right, so typically a manufacturer facility, so I'm the production manager, right? So like facility manager for a production facility manager. So I'm responsible for making the products, but I'm not selling the products directly to customers. So then my function is a cost center. So lots of the manufacturing industries, their production departments are cost centers, right? So like, and even lots of the, I think the admin functions, right? So accounting departments, HR, research development, right? And they incur research and development expenses and other admin expenses. They can be defined as cost centers as well. And how we can evaluate the efficiency of a cost center, we use the budgets, right? So like we learned the master budget from chapter 9. We prepare the selling admin expenses budget. Right? So you can use the budget to control and monitoring the performance of a cost center. So you can compare their actual cost or expenses levels with the flexible budgets, right? Like month by month, year by year, so that can be monitored for cost center. Then we have the revenue center that's on the opposite of the cost center. The revenue centers are mostly your marketing and sales functions. Right? They hold responsible for the revenue generated from the customers, but they normally don't really make the products or provide the service. So they are the advertising person, right? So promoting the sales to customers. So in addition to the amount of the sales, they are also normally responsible for when the revenue are received. For example, they sign a contract and the revenue will be received 3 times, right? Like, in the next few months. So like the contract, the details, and the mix of the products and the service sold, like they can sell products and also the services related, right? A 1-year service plan or 2-year service plans, discount, right? So any cash discount or like a price discount directly, and also credit worth. So means the credit assessment, right? So can we award credit sales, and how long the collection period of the receivables, right? So customer evaluations, right? So that's normally for the revenue centers. So the reservation department of an airline company or advertising sales department of a mobile app. So marketing and sales is a critical function, I believe, for all for-profit businesses. Then even higher, okay, if we elevate to a subunit who can be responsible for both the revenue and the cost, so it will be a profit center, right? So like we have lots of examples around. If you see looking for profit centers, each restaurant, right? So the 10 restaurants, the tea shops, Starbucks coffees, so the coffee shops, each of the shop itself is a small profit center of the whole company, right? Because they are directly selling products or providing service to the customers, and they incur direct cost to sell the product and providing the service. So the managers of a profit center has more responsibilities on the revenue side and the cost side. And then finally, the highest one we call investment center. So investment center has more responsibilities than the profit center. By the way, they can decide the way they allocate or they use the profits generated from their operations. So for profit centers, after they earn the profit, the manager couldn't make a decision or how I'm going to use my profit. So they only generate the profit. Then the upper level, the investment center, then they make decisions for all of the profits under their responsibility scope. So normally, like an investment center can control a few profit centers, right? So not only one. So an investment center itself can be a profit center, or it's depending on, so it can be a single profit center, or it's managed a few profit centers together. But anyway, the managers can decide. So I highlighted how they are going to use the profit earned. They can decide to use the profits to pay as actual bonuses to the employees, like management. Reinvest the profit, add more profits into the research and the development. So develop more popular products or services, and use it for expansion that's normally related to equipments like the scale, right? So buildings, more equipments, build more facilities, or distributed to shareholders means paying more dividend, or use the extra cash to buy back their own stock. Because when you buy the stock back, we have less shares outstanding in the market, and normally the share price will go up. So that's a benefit to shareholders. Another interesting point I probably already also noticed the operational problem, right? So the problem for Boeing, the airplane makers, right? So can continuously from early this year, they caught in different quality problems, right? The really serious accidents happened during the flying time. So the door, like the emergency door, fall off. The plane caught on fire, and something fall off. Right? So I just read an article talking about how Boeing developed into this stage. It's not something overnight. It has been the seed of the problem was planted kind of 20, 30 years ago. And because I thought this very interesting, because a few of their prior CEOs, chief executive officers, they changed the company's, like the company culture from a engineering priority, right? So like really meticulous on the quality of the products, and they become playing like Wall Street games, trying to please the Wall Street, try to please the shareholders by using the profit, so cutting the research and the development cost, but paying higher dividend, so double their dividend payment and use the profit to buy their own shares back. So you can see that's really cutting the development fund of the company, but they try to please the Wall Street and the shareholders. And gradually they lose the momentum of their quality products. And also I think some general, quality, like inspection issues going on, right? But this is a life critical industry. But I feel so sad and upset, kind of, right? So their current CEO is expecting to retire. They are searching a new one. But the article, I think I can share that article to you. But as I said, the root problem for Boeing is not just to change a CEO or change a couple of managers, is they need to restore the face, right? So face of the consumers and the passengers by restoring them, by putting priority on the engineering quality of their products rather than like refurbish their financial statements reports and just to work on, the numbers. Yes, I'm kind of like an accounting person. I feel really bad about this, right? So
Yeah.
yeah, right. So it's not a superficial, right? Superficial. I'm just, giving you a nice report, but this is life threatening, right? Like, yeah, that I
Right.
hope. Yeah, so I hope that's so I can share that article. That's pretty interesting. So even it's
Okay.
not, yeah, even it's not only about accounting, but it's really some accounting is about management, right? So that's
Okay.
like, yeah, factors, playing together. So. But anyway, yeah, that's I'm saying investment center, right? So once you earn the money, they got a lot of money. So I think that they said the peak time of the Boeing the stock is like over $400 per share. But after that Boeing 787, like they have the like the airplane crash, and it dropped to like 99 something, and now it's just picking up, but now they got another blow off. Hope because we only basically have two major airplane makers in the whole world, right? So Boeing and Airbus. Like I don't want to like lose any one of them. So, but anyway,
Okay.
yeah, yeah, that's something like side issues, but some kind of, okay, when I see this, how you are going to use the money you earned, right? So rather than just looking for short-term issues, is for sustainability and long-term. okay, like development. But anyway, so as we talk about this, when you see the example, it will be pretty straightforward. So we are looking for a hotel chain. I don't really think this is probably they modified or from the real hotels, but they changed the name, like this like a case. So they have a hotel chain operate in Hawaii, and this is the headquarters, right? So like they call hotel and resorts. It's like Hilton, like resorts, or like the other, right? So the big hotel chains, but this is kind of a regional, right? So a local hotel chains and resorts. And underneath they have two locations, right? So like Maui and Oahu, so two divisions. Then we focus on one of them. Okay, so you can do the similar analysis for the other division. So they talk about, so the headquarters is definitely a investment center, right? Because it's responsible on controlling all of the divisions and the hotels, and they have the power to decide how they are going to use the earned profit, right? So for maybe building more hotels, or building expansion of the hotels, or refurbish of the hotels, or do something else. So they are definitely the highest investment center. Then the two divisions, they are responsible for the hotels under each division. And they also have some power, not really unlimited power, to decide the profit distribution. I think the book mentioned each of them, they have a investment decision, like a budget, 300,000, right? So, but below that, okay, that can be maybe a swimming pool addition or some resort, like some like resort addition, but not beyond 300,000 investments, right? So limited investment centers. And then underneath now we see the hotel. Each of the hotel, okay, we are picking the Waikiki Sand Hotel as an example. So because the hotel itself is like a restaurant, right? Like a coffee shop, is serving the guests, right? So customers, so making revenues directly. And also they incur cost expenses to operate the hotel. So the hotel manager in this case is a profit center, right? So revenue, they are responsible for revenue and cost, but they don't have any power to decide the profit or they earn. The divisional manager and the hotel CEO are the decision making of the investment. Then under the hotel, we have, now you can imagine they have this kind of standard departments, right? So under the hotel, they have hospitalities, they have reservations, then room services, restaurant, and food beverage, right? Then under the food and beverage, they have the kitchen. And now let's look, the food is depending on, right? So most of they have the like different restaurants to serve the customer, like guests directly, or catering services, or like for events management, right? So conferences. So it can be a small profit center if I have a on-site restaurant, right? So think about, so each of the restaurant, we know lots of the large hotels, they may have 4 or 5 different restaurants, right? Some of them, they serve breakfast or lunch or dinner, right? So if you are, this full service restaurant, right? Or even like a bar, it can be a smaller profit center under the hotel management. And then if you're looking for the kitchen only, like a kitchen prepare the food, and they are not facing the customer or service director. The kitchen will be a cost center, right? So it's really right on the bottom, right? So that's like what I'm talking about. So under the food and beverage, we may have the restaurant as the profit center. Banquets and the catering probably as profit center, but the kitchen is a cost center because the kitchen provide food to the restaurant and probably to the banquets and the catering, right? But the kitchen itself is responsible for the cost of the food and the beverage, right? All of the ingredients, the chefs, the laborers, and other supplies, like those. So that's how. But this one is, you can see, is pretty straightforward, not really a complicated operation, right? I think this is kind of similar to our, like TSU is a not-for-profit, but think about our organizational structure, right? So the best way we understand, so you look for the organizational structure. So for TSU, we have the board, right? So we have the board, and under the board, we have the cabinet of the management, right? So like the presidents and then the provost, right? So like, but you can see this is central management. And then we have the non-academic divisions, right? I don't like, they have financial services, like HR, like OIT, right? So we just mentioned, and then the college and the schools. And the college and the schools, definitely we are, I think, a cost centers, I believe, because I don't really think we can control the tuitions, right, collected by, the tuition will be paid directly to the financial service, I believe, right? So by the school, so it's on the top. But anyway, so we are not really profit seeking entities, right? So most of the functions under TSU are like cost centers, right? Library, even and the food services you think about, can you really define it as a profit center? I'm unsure, right? It depends, like the faculty lounge, student dining hall, and we have this small like food services in the different buildings, right? But just like think about the way, or if you have interest, that's something you also can take a look for the companies you are working, right? So what's my organizational structure if I want to define each of them? So what's the best responsibility they can have, or for different divisions? But anyway, that's so this is large, so it's continued this figure. So now you can see the managers, okay, from the, like we talk about their role, and then the responsibility center type. Okay, so depending on the resources they have and the power they can make decisions. And that's one we saw the hotel chain, the division, right? So a smaller investment center than the hotel itself is profit center. And the food and the beverage combined is a profit center, right? But the kitchen is the cost center, okay, which is controlled by the head chef. And the profit center is because we have the restaurant and the catering services. And yeah, that's more explanations. Okay, we already. So I will leave you to read more on the corporate level, division level, hotel and departmental, and the kitchen. Okay, so layers. And now I think before we finish, let's take how we prepare the internal performance reports, okay, for the internal, like for different responsibility centers, because even they decentralized them, okay, into the different units, But eventually, when we try to make evaluation, we need to pull them together. So decentralize and centralize them together for performance evaluations. Depending on the cost, depending on the center type, you may develop a different evaluation framework, right? So for cost center, for example, we have a figure here. Yeah, let me enlarge. So for most cost centers, okay, not only for the kitchen we are talking about here, you can use it for like a financial aid office or accounting department, but any cost center we use a variances analysis. So budgeting or is connected to budgeting and variances analysis. So this is the kitchen flexible budget, okay, annual budget, year to date and month by month comparisons. But be careful when you do this, we have a flexible budget. So flexible means when you make the budgets, like when we talk about in chapter 9, we talk about flexible budget versus the static budget. Static means I only make the budget for one level of service. So for example, I'm expecting the total guest visits next year. Okay, I'm saying I'm just 100,000 guest days. Okay, 100,000 guest days for next year. And I'm making the budgets based upon this 100,000 guest days. And I wouldn't allow for any deviation of the budgets. So if the guest visits can be larger or smaller than my expectations. So, when the actual guests over exceed or under, I got a problem because I only have one level of the budget numbers. And to avoid this static, when we plan the budgets, just like we did in chapter 9, we make a prediction for the fixed cost and variable cost separately, right? So when you have a cost item, or you can use the ABC cost driver analysis. To analyzing for each cost item, they are a fixed item or they are variable and they are driven by different cost drivers. So I would give a rate rather than, like 100 guests or 200 guests. I wouldn't really do a total variable cost. I will give, for example, food cost, right? So variable food cost per guest a day, I may say $30. I just made this up, okay? So it's not really. So you give a rate budget, then they can apply this rate, right, to any volume of the guests, right? So similar to our students, we never know how many students will enroll, right? So exactly in the summer or in the fall. But what we have is a tuition per credit, right? Or something like, but the internal service cost, right? So tuition is a revenue, but how much, like 10 students in the class, right? So we require a 10 students minimum to open a undergraduate class. And probably 8, I believe something for graduate. So that's why you require a minimum of 10 or 8, because we want to maintain the, otherwise it's really not feasible, right? So it's like our break-even point, right? So not really break-even for education, but you need to balance the tuition and also the cost to offer the services, right? So we rather have like a concrete total expense, but we would say per student how much the tuition and then how much the cost, like adding the faculties and the maintenance, right? The classroom management. So I think I remember last week, the interim, Dr. Booty Kun, I forgot her
Right.
title. Yeah, Booty. Yeah, she sent out the email regarding the classroom, like arrangement for all of the courses. They said, oh, for if you have a class size over 25, then that's your room choices, right? So you place the student's number in the most suitable, like the room with the size. You should not put a 25 students in a 100 like students capacity auditorium. Is not cost efficient, right? So that's all things you need to consider about this when you make the budgets, right? So like after they fix the volume of the class and the classroom, then TSU we can make a more accurate estimation of our cost of the cost of the service in the fall, right? So once they finalize the classroom arrangements. So that's similar thing here. So when we read this result, it's similarly, everything is so simple. I'm just, but is how you come up with the data, right? There's lots of.
How do you, I'm sorry, how do
Mhm.
you, I'm reading it and I'm looking at it. How did they get the flexible budget year to date? I see the kitchen and I kind of figure, I see the February and the year to date. How did they get that?
Okay, you mean the flexible, this one, the 168?
Yes, yes.
Oh, yeah, that should coming from your like stuff which that should be like you have a rolling monthly flexible budget.
But
Rolling.
they give you that?
Yeah, no, it's not given by the book. So that's I'm saying. So the numbers they should have lots of work behind this table. They come up with this 168,000 or even the 80,000.
Hmm?
But it's not given by the book.
Oh,
Yeah, that assumes that I'm saying, for example, like our budget, right? So yeah, we can get the idea because February is 80,000 and year to date is 168. Then I think the January flexible budgets it should be like 88,000. So use the year to date minus the February. So behind this table, they should have the detailed budgets is month by month, like flexible. So January, February, March, and April, because each month they have this seasonal. For example, like if we have the spring break, normally in March, right? Like for TSU. So probably our flexible budget in March, like the
so yeah, I'm reading and I'm looking at it. So because of February you got 80, how would you add 88 to the year to date?
Oh, I'm just saying that they didn't mention because the year to date should be January and February, right? And February is 80,000. So I believe January should be the difference between these two numbers.
Oh,
Mm,
oh,
mm.
okay.
Yeah.
So if you do you normally if they don't have it, is it assumed that it's doubled plus? Because you said it's flex.
No, it is case by case. That's what I'm saying. So it's depending your actual, like you have seasonal adjustments. Like, for the hotels, I don't know for Hawaii because, some of the tourists, they have the peak season in the summer, right? So the peak season, they may tripled or like 4 times than the unseasonal, like the month, like the winter or something. So that's they need to have a rolling monthly, so the budgets will be more accurate.
Okay.
Yeah, that's I'm just saying the budgets behind this they should have more details. So let us understand how they come up with the budgets for all of the different items. But basic thing is you better separate the variable and fixed, right? Because the we estimate is different. Like the fixed, you can see this fixed overhead. I would think even you can see the monthly difference, not really every month is equal for the fixed overhead, like your rent or maybe some other like insurance stuff. They still have some variances.
Okay.
Yeah, and yeah, 85,000, I'm looking for 85,000. If we double that, it should be 170, right? But they have 180. So I'm thinking I'm sorry. January they have higher. So January they probably have 95,000 of fixed overhead.
118, 16, 170.
Yes. Mhm.
Okay. So like they added. Okay.
Right. Mhm. And now the actual results, you can get these numbers from your accounting system, right? So like the operational system, we have the February actual cost and year-to-date actual cost. Then we can analyze the variances from month to month and the year to date, right? They have rolling, like this. So for maybe like for this month is you can see there's opposite variances. For February is favorable, like the first item. Okay, the staff wage, they save the money for February, but year to date, we still have 1,000 unfavorable. Now you can know the reason is probably in January, we overpaid. And this overpay, again, the overpay doesn't really mean like bad things, because you need to also compare this with your guest services. Like, maybe we got more revenue earned, right? So it's like variable or fixed. So you cannot really say favorable is good or unfavorable. You need to combine the revenue side, because the restaurant and the catering, they checking the revenues, right? But the kitchen is offering the food. So the cost that happens in the kitchen and the revenue earned by restaurants and the catering. So we need to combine the two sides to evaluate how the food and the beverage departments, right? So is this really, we didn't make that much revenue, but the cost is high, then that's really bad, right? So that's just the case by case.
Okay.
Yeah. So variances, analysis. Let me see. So I think this is the one, and this is only the one department. And now this one I know is a little bit small, so let me open this. Yeah, let's zoom on. And this is how the kitchen will be rolled over. So the kitchen will be rolled over to like a level by like, so one step higher. So initially you see all of the kitchen. Yeah. So let's see the bottom first. Oh. And this one, if you see the bottom, this is the table we just like discussed. So the kitchen itself as a cost center. And now we add the kitchen result to the other two departments under the food and the beverage, right? The banquets, I'm saying the revenue centers or the profit, or you can say the revenue center or profit centers. And that's not make sense, because the other two divisions, they make revenue, they serve the customers or the guests. And the kitchen, this is where the cost happens. So overall, the food, you can see this row. That's all of the revenue, or like profit. The food and beverage is a profit center, right? So we have two revenue center and one cost center. So overall, this is the profit earned by the food and beverage. We have unfavorable. Let me see the top. February and year to date. Okay, now we can see we now got the big picture. So for the food and beverage, the overall we have a unfavorable February difference and also a cumulative 10 like unfavorable for, I think about this is in 1,000 or something, but both February and the year to date is unfavorable, okay, for the food and beverage, because you are looking for the profit as the, like, from the budget. And you can break it down. Yes, we have revenue favorable, right? So both up, but restaurants, you can see restaurants, they have a large to unfavorable because we didn't examine what happened on the restaurants. But from here as a manager, right? So if I'm the hotel manager, when I look for these reports, so which division you may question, right? So majorly you should question what happened in the restaurant, right? So they didn't make probably enough revenue as expected or budgeted because the catering is all favorable, and the rest, like the kitchen, we have one favorable and a smaller unfavorable, but most unfavorable happens for the restaurant, right? So the variances analysis give you idea, how to pursue the research, pursue your questions about the operations. Now we roll the food and beverage to the overall hotel as a division, like profit center. The under your hotel, we have a ground and maintenance. That's a pure cost center, right? So we can understand. Housekeeping and custodial, that's a cost center, should be. Recreational services, that's probably, I'm thinking, a cost center as well, recreational. And then hospitality, that's the revenue center, right? Because that's the one they sell the rooms and they handle the customer revenues. And plus the food and the beverage, which is the profit center. We can tell because that's the revenues we earned. And they really have this seasonal, right? Difference year to date. So February and then year to date, right? So the first two columns are the budgets. The next two columns are the actuals, and then you can analyze. So the hospitality, the revenue, we have both favorable, right? So we earn more revenue than budget. But the food and beverage unfavorable, but combined for the hotel level, we have both favorable for February and year to date, right? For the Waikiki Sand Hotel. Now, if you want to roll over, like continue rolling up, and the pink one means the one, this chain we look over, and the other two, they just gave the number. So for this hotel, favorable. But now you're looking for the other two hotels under this division. The Diamond Hand Lodge, they have big unfavorable, right? Both February and year to date. The other one, the beach resort, monthly favorable. Yes, like also year to date is favorable. So again, if you are the Oahu divisional manager and which restaurant, which hotel you focus on, then should be the second one, because that's where most of the unfavorable variances incurred. And now continue, you roll up again, you're to the division level. Maui is doing better than the Oahu. Yeah, you can see the Maui, they have both favorable, but the Oahu is you have now you can look at then how the CEO of the company, right? So like looking for these variances and which division, and this is really give you a drill down even. So when we offer the data, we are offering the data from the bottom to the top, right? So layer by layer. But as managers, they don't work in the bottoms, right? So they are overlooking from the top. So when they got this piece of report and they will identify the numbers, they should notice and pay attention, right? Where are the most problematic operations, right? Divisional, hotel level, or like department level, they should focus on to, to tackle the problem. Oh, that's like, I'm just saying. So performance evaluations. So that's like from bottom to the top. I think that probably should be the most of it. And notice the relationships, okay, the hierarchical. And this is really a hierarchical, but think about if they have overlappings, actual performance can get much more complex than this. Think about if we have crossovers. Because I talked to like students before, in the actual practice, sometimes it's not very easy. I can call, oh, revenue center. Sometimes I talked to a student before her company because she worked on like a research and development. Basically, we think research and development is a cost center, right? So cost center, they are responsible for the R&D cost. But the actual situation is, she said, when the sales got a customized special customer order, they talk to the R&D. So R&D will design like the model, like computer model, especially for that customer order, and then they can send the contract together. So R&D also involved in some parts of the sales functions. So they can determine this special model, how much they can charge the customer. Because this is not a regular model we sell to the customer. So in that case, they can play in the pricing decisions, and also for the special model, what will be the cost to make it, right? So you can see this is really a combination for both cost center and a revenue center or profit center. So she was asking me, oh, so what's the best KPI, or how should I define my division? I see if you can probably like break down, right, your two parts, right? So cost center parts and this customized sales. So if you can have a sub system under your own division, right? So you can track both of them correctly, or rather than, so actual applications is always like catering to the special needs of the operations. So that's, but when we teach, normally we only can give you this, you know, the framework, right? The fundamental framework. When you implement, we sometimes you can hire consultants. That's why the consultants can charge so much pricing, right? $1 million like for a project or something, right? So everyone probably know the concept, but implementation need experiences. I think that then they talk about, yeah, like I mentioned, the cost allocation. So how to make reasonable, accurate, and acceptable cost allocation among the different divisions or among the departments, like the one we went over. Kitchen is a cost center. And then restaurant and catering are the revenue centers, right? How we allocate the kitchen cost to the restaurants and catering, you know, by the guest or by the actual food they used. So because if you allocate it in different ways, that can play a role, determines how, you know, the profit will be allocated and how the cost, like the profit center overall. Okay. So that's like they talk about admin, the cost pool, right? And they can use, so in this case, the ABC, activity-based cost drivers, can help to make the job, okay, more like so combine. So they allocate the cost center using different cost drivers or allocation base, right? They use the employee numbers for the maintenance, housekeeping, and then for the facility type of cost, right? So different cost features use the square feet, the area of the facility maintenance. And the marketing use the sales, we like marketing, because the recreational and hospitality are the two revenue centers. So they only allocate the promotion like advertisement and other advertising cost to the two divisions, and also the food and beverage. So these three divisions are taking all of the marketing expenses by the revenue they made. So most of the revenue made by the hospitality, so they take 80% of the total cost, marketing cost, right? So 16% goes to food and 4% go to the recreational. And then they break down this, okay, for this marketing, okay, as an additional example. And just the final page, I will leave you to read more, okay, on this behavior side of the responsibility of accounting. Because if you didn't really design the system correctly, what you can imagine to end up, right? So blame each other, right? Try to just focus on maximize their own benefits, and then everyone is working. So you may have 5 departments working for different directions, right? So that's like similar to the budget, right? So sacrifices controllability and motivating the desired behavior. Okay, when you design the system, so like I think this is the example I mentioned in the beginning, how to balance the demand for the rush orders, how to balance the workload and also the revenue between the sales manager and the production manager. Okay, so there's like lots of interesting issues you can check, and also to see the real world, okay, cases, how we can, handle this. I believe like we have some issues talking about like in the school is how about the students cross-listed, right? So some students, they have the major in science or engineer, but they take a accounting minor, and all they take like business classes, right? So how I don't know, it's like if like you need to allocate the tuition between the schools and the college, right? So how you are going to, that's something similar, right? So how to balance and take a consideration of this responsibilities crossover, right? So these things. Okay, I think it's just a little over. So I think I will stop here. So you can continue to read and let me know questions. And on Thursday, so we can talk about the rest of the chapter. Okay, so segment reporting. This is especially for a profit center. So how we put the segment performance and together with the overall for the whole company, and also the balanced scorecard.
Okay. Okay.
Okay, thank you.
Yes. Thank you.